Hello and welcome to the Fat-Tailed Thoughts podcast. I'm your host, Stephen Dickens. I'm joined as always by Jared Klee. Hey, Jared, welcome to the show.
Good morning, Stephen. How are you?
Yeah, good, buddy. I'm not doing as well as the dog behind me. It's a
He found a
great
warm
life.
spot on the couch, apparently.
Yeah, sun shining, couch to lie on. The world is good. So, for new listeners to the show, this is where Jared and I talk about the makings and workings of finance, crypto, and fintech. This week, we've got a topic that's becoming a recurring theme because we continue to get interest. This is around, can you sell your startup equity? So, we all know startups give their employees and founders equity. Incentives align, you work hard, the equity in the company increases in value due to the work you've done. Fantastic alignment of incentives. However, there's some structural challenges in that. So this is what we're going to talk about this week. Jared, just get us orientated here. Give us the sort of intro and problem statement, if you would.
So let's break apart two worlds, Stephen. When we see like headlines like such and such company, so Fireblocks, for instance, just raised a $550 million round at a $8 billion valuation. That's the primary market. What that means is the startup is selling shares of itself to investors. And when employees get shares from the company in an employee compensation program, we can think of that as a quasi primary market as well. Again, the company, the startup, is selling shares in return for labor. A secondary market, which is where we're going to focus, is for those employees, those existing investors, those founders, existing owners of equity, existing owners of stock, selling to other people, other potential owners. They may be actually selling back to the startup itself. The challenge is, and we've hit on this in other topics, that is a wildly illiquid market, meaning there's no readily available price, there's no readily available supply of stock or of buyers. There's also a whole bunch of regulatory constraints. There are a bunch of good reasons that startups don't want their employees or their founders or their investors to sell. Nonetheless, there are good reasons to sell. There are good reasons for startups to want many of their early employees and owners to perhaps be able to get access to some cash. So in the last couple of years, an entire ecosystem has grown around that. And we're going to dive into both the mechanics of why it can happen, what are the challenges around it, as well as then, okay, we've agreed it's a good idea. Now, who do I go engage? What are the companies out there I can work with? What are the differences among them?
So let's be super clear here. This is not a company selling to venture capitals. This is not a Series A, B, C round where they're selling equity to sort of further change the cap table and drive growth of the business. This is, you have been working at a startup for 3 or 4 years. You've got some equity. The company's giving you that equity to incentivize you to work harder. But you need to put your kids through college. You need to buy a house. You want to buy a car. Whatever that situation is where you need the money, you need some cash. You're illiquid, but on paper, you've got equity that's worth, could be quite a lot if it's a Series C, Series D type round, like the one you mentioned there with Fireblocks. How do I go get that cash?
Correct, but I do want to include there are good reasons from time to time for early investors to sell, for founders to sell as well, perhaps not all of it, but chunks of it. So Stephen, the focus, yes, is very much on the early employees who probably are what we'll call equity rich and cash poor. But there are other people in that camp who are going to want similar access to liquidity.
So let's start with the fundamentals first. Can I sell? I'm working for a startup. I've worked for them for 4 or 5 years. Maybe I'm the founder. Maybe I want to fund a different business venture. Whatever the situation of where I need some cash, I'm the classic person you just described. I'm equity rich, cash poor. I want to flip that equation to some degree. Can I sell? Obviously, I'm in the company's in a private market. There's not a public market like an exchange I can go put my equity on. Talk me through the process.
Short answer is yes. Longer answer is there's a bunch of nuances here. So the company, the board and the company executives are going to want to have fairly tight control over the ability of anybody who's an owner to sell, and for very good reason. The first reason, Stephen, is back to what you hit on, that incentive alignment. Especially when a company's younger and maybe only a couple hundred employees, equity plays a major role in keeping the employees, the founders, the investors bought into the long-term vision of the company. The work that that group does on behalf of the company actually increases the value of the equity that they own. That's a major driver to keep doing good work, to put in the long hours. From the startup standpoint, that's actually quite a good deal as well, because they have to spend less cash today. As opposed to paying you a large salary, they can pay you a smaller salary and give you a chance at sharing in the upside. That's a win-win all around. The moment you try and go and sell your equity, that harms that incentive alignment. If you don't own the equity, work 9 to 5, you're getting paid the same no matter what.
Well, it goes even further as well. I mean, imagine that equity stake was worth 2 or 3 million. Could be a life-changing amount of money for some people, and that could really change their incentive about whether they get out of bed every morning and whether they're prepared to work into the evening. If life is good and happy because you've managed to cash out and you can live frugally, 2 or 3 million's an amount where that could be life changing for some people. I'm thinking some developer who's sitting on that type of equity because they just got in early, the ability for them to continue, the desire and incentive for them to continue working gets fundamentally changed by that cash out.
Spot on. Spot on. So there are other ways other than just outright sales. And this is where, if you've ever received equity from a startup, you'll find just saying no selling is the place to start. But then there are a whole bunch of terms on, we'll call all the other things that you can do that are kind of like selling. They end up with the same incentive alignment problem, but they're not actually selling. And we'll just generally lump them into pledging. Good examples of that, Stephen. You sign an agreement that says, I will sell you the equity in the future. We agree on the price now, and I get paid today. Again, in that case, you still technically own the equity today because it's an agreement to sell in the future, but you've given up all the economic upside of whatever happens. Again, it hurts the incentive problem the same way. If you try and take a loan out against that equity, well, if you fail to pay back the loan, you give up, you lose the equity. Again, similar problem. We could talk about gifting to nonprofits or to families. There's a whole bunch of ways. In general, a startup is going to wrap all of that stuff up and say, as a baseline starting point, you don't get to sell. You're not allowed to pledge it. Basically, you're stuck holding on to the equity until we say differently.
And those restrictions sound cumbersome and sound an issue, I think, for both sides. Is that the sort of summary here? Right? I mean, I get you want to keep the incentive alignment, but that's a challenge for people who've got to go live their lives and may need to, as I say, put a kid through college or pay for put a deposit down on a house.
Correct. That's the balance, Stephen. And for an early stage startup, especially when it's just a handful of employees, that the equity plays a major role in incentive alignment. As the startup gets older, one, the startup probably is getting bigger, in which case the ability of any single individual to meaningfully impact the value of their equity goes down. So that incentive alignment, they're kind of just along for the ride with everybody. So the incentive alignment decreases. Equity is not as strong a tool. But two, as you're rightfully pointing out, if I've been a startup employee for 10 years, for 12 years, and I've been getting paid a fairly small salary compared to what I could make elsewhere, but I got a lot of equity, well, I can't go to the grocery store and turn in shares. I can't pay down my student debt with shares. I need cash. And at that point, you've got kind of the alignment flips, where in order for me to stay at the company as an employee, I need cash. So all of a sudden the startup's incentive flips and they go, how do I ensure that especially the early people can get access to cash so they can continue to stay working here and continue contributing?
And that's a key point, and you touched on it in the letter, but I want to expand on it here on the podcast so that we can get some extra color commentary around it. The time that these companies are staying private has fundamentally changed. You touched on it. If it's a 5-year time horizon, you start this thing, it IPOs 5 years later. That's one type of time horizon. You mentioned Palantir in there. I think it was 17 years before.
Palantir was 17 years from the time they got founded to the time they went public. And I mean, 17 years. You can have a kid and the kid can be born and make it most of the way off to college at that point. I mean,
yeah, that's not a bad thing if you timed when you started with the startup and then you needed your kid to go to college. That would have been a great sort of, but obviously not everybody's life lines up around Palantir's IPO plans. So talk me through what the mechanics of what's fundamentally changed here, because I get the impression that we've seen a dynamic around IPO as the classic exit. There's obviously other exit SPACs have come to the fore of late, but regardless of what that exit mechanism is, the length of time that company's staying private seems to have changed.
It's gotten longer, Stephen. It's gotten a lot longer. So if we go back to, and I picked 95 to 2005, basically starting with the dot-com boom and then cutting the dates off right before the financial crisis.
You've got to be careful about which dates you pick because you can change the outcomes.
Yes, I can. This one, by the way,
I
did look at taking earlier and taking later. The data doesn't change too much. It's within a single year. So
I'm watching for you now, picking those dates on that chart after last week. I'm watching you, so be careful.
This one is robust, even if I change the dates. Go back to 95 to 2005. Average amount of time a company, a venture-backed technology company, stayed private before going public was just over 7 years. If you change the dates a little bit, it gets as high as 8 years. But in that entire period, Stephen, there was no year where the average length of time was greater than 9 years. So even in the longest period, you're looking at 9 years from private to public. For listeners' awareness, the longest you can date employee options. So rather than getting equity outright, you get options, the right to buy equity at a predetermined price. Legally, the longest that options contract can be outstanding is 10 years. It's 10 years minus a day. So 9 years, you're still under that threshold, meaning your options are not going to expire before the company goes public. Fast forward a little bit. Fast forward to the last 5 years. The average time it took a company to go public was 12 years. And at no time in the past 5 years, they dropped below 11. What that means, Stephen, is even the lowest number in the past 5 years is outside the range of what an options contract can live for. That's a problem if you're an employee joining on day 1, day 2. Your options will expire before the company goes public. Well, again, if you're cash poor, you don't have the cash to exercise the options to buy the underlying equity. Even if you do have the cash to exercise the options, you're going to take a massive tax hit. What happens is the difference between the strike price and the current price of the equity, you pay taxes on that the moment you exercise the options.
That's a capital gains, basically.
You would wish it was capital gains. That gets taxed as short-term income. So you don't get the benefit of the 15% long-term. Instead, what you're almost certainly going to trip is the alternative minimum tax. And that's just shy of 30%. So you're going to get,
as you say, if you're cash poor, is a chunk of money.
So this actually, if we go back in time in the late 90s, this all blew up in a really big way. In the year 2000, there were a series of companies that went public. Folks exercised their options. 2000 happens, the share price crashes. They had exercised when the share price was high, the share price crashes, and all of a sudden they owe a tax bill that is greater than the total value of the equity they own. So never mind selling the equity. Early employees who had been paper millionaires for a couple of years woke up and found themselves bankrupt. And we had a whole series of congressional hearings around this that's helped solve some of these issues, but that issue still remains outstanding.
So those congressional hearings didn't lead to a sensible resolution.
We'll call it
notice the surprise in my voice, but
yeah, exactly. We'll call it adjustments and some improvements, but absolutely, Stephen, there are many scenarios where if there have been a handful of startups recently that went public and the share price is now down 75%, from the price where they went public. There are absolutely employees out there who had options. They went public. Those options, they took an enormous gain, and then they woke up one day and the value of the equity they still hold down 75%. If they sold all of it today, would not pay for that tax bill.
So the moral of the story is if you're in that situation, sell as quickly as possible.
Well, that's always the challenge. Is you can cashless and a bit of a rabbit hole. You can cashless exercise early, meaning you effectively sell some of the options back to the company, and then the proceeds from what you sold back to the company are used to exercise the other options. Well, Stephen, this gets into fairly nasty math. First off, you're still going to owe the tax bill on both of the gains, for the cashless portion and the portion that you own. But two, if you do the exercise early, the cashless exercise early, the options you're selling back to the company aren't worth that much. If you wait a long time and the value of the company goes up, those options are worth a lot more. So it's this really nasty math of, do I wait until the options are worth more, but my tax bill is going to be bigger? Or do I do it now and I'm going to be left, my tax bill will be smaller, but I'll be left with less equity in the end?
So this sounds like a minefield. We've got what on the surface sounds like a really solid alignment of incentive for both the company and the employee. You know, there's a reason why people like going to startups. That incentive alignment sounds solid. Then it seems to waver as we get into the challenges around the length of time these companies are staying private. Then as we look at exits, you know, IPOs, SPAC acquisitions, you know, whatever the exit strategy is for that startup, there's fundamental challenges that can lead to disincentives, lead to challenges more accurately for the employees. In the letter, you started to hint towards companies that are entering this private market space to kind of, there's enough problem statements in what I just said there as a summary for somebody smarter than me to be able to think this is an opportunity. How do I go and address that problem? So give me a sort of view into some of those companies that you hinted at in the letter, and really how they're fixing the problem we spent the last sort of 18 or so minutes talking about.
There are four major companies in the space. That there are, by the way, a long tail of smaller ones as well, Stephen. EquityZen, Carta, and it's the product is called CartaX, Forge, and NASDAQ Private Markets. Those four are certainly the biggest. If folks who are familiar with the space are thinking of SharesPost, SharesPost actually merged with Forge a few months ago, maybe a year ago now. Forge used to be called Equidate. So if you know that name, and if you go back even further, the OG in this space was Second Market. They got acquired in 2015 by NASDAQ, and they are now what's now known as NASDAQ Private Markets. And for folks' awareness, this is very much a dynamic space. At the time we're recording this, there are four major ones, but Forge is actually in the process of going public. They're getting SPAC'd, on track for this quarter with Motive Capital. NASDAQ announced maybe 2-3 months ago, they're actually spinning off NASDAQ Private Markets into a separate company. Goldman Sachs is involved. It's going to be a joint venture. I expect we're going to continue to see a lot of movement in this space. So treat those four as a point in time statement.
So what are fundamentally, what are those? I mean, obviously 4 different companies, 4 slightly different value propositions, 4 different approaches to the market. Fundamentally, what are those 4 companies doing? I think we've spent the first 20 minutes describing the problems and some of the challenges. What are those companies doing to address those challenges?
So one challenge we didn't hit on that they play a major role for, Stephen, is there are a whole bunch of regulations that limit the size of the cap table, meaning how many investors you can have in your startup. There are a series of related regulations that limit how much money you can raise and how many secondary sales you can have a year. Bunch of restrictions around this. One of the value propositions, in addition to all the paperwork of actually transferring shares and so on, one of the value propositions of these 4 companies is we will help you manage the regulatory stuff so you stay on the right side of it. And that is a fairly major one. That can be a huge hassle to stay on the right side. And if you screw it up, the consequences are quite severe. For the most part, the biggest consequences is you become what's called, quote, a fully reporting company. Fully reporting is what public companies do, Stephen. It's you get audited, you publish quarterly and annual, and so on. It's a massive burden that startups are not ready to shoulder. These guys, the 4 we talked about, help them stay on the right side. The core service of all 4 is, we'll call it a matching service. Employees, founders, investors have equity. They have shares they want to sell. Buyers may want to buy. As we've talked about in other illiquid markets, you can't just have an order book that lists, hey, I want to buy and hey, I want to sell. There's too big of a gap. There's an information gap. The employees and founders know a lot about the companies. The buyers don't know so much. You don't have that many shares available at a point in time. They don't know where to all meet up. As we said, we've got 4 places for them to meet up to start. This is a very manual effort. This is a white glove service, a high touch service. It is informed by data. It is facilitated by technology. But at the end of the day, the baseline service here is kind of a traditional broker service, a person who is matching up buyer and seller to meet around a price and to exchange. Now, that's a fairly high cost model. So as a result, the minimums for most of these platforms tend to be quite large. On Forge,
Because you're just not going to do the work as that matchmaker. This is going back to what we talked about last week. That matchmaker, sort of market maker type function. We're talking about one of those illiquid markets that we hinted at last week, where there's a lot less buyers, a lot less sellers. The frequency of when those transactions are going to happen is a lot less regular. The ability to kind of skim off that margin that you would get in an Apple shares market is a lot different because there's not the volumes, there's not the sort of buyers and sellers on each side of the equation. This, as you say, is hand tending buyer to seller in a white glove service.
Correct. And just for context for the listeners here, when we talked about the public markets, Jane Street is one of the largest market makers in the public markets. In 2021, they transacted $17 trillion in stuff across the equities market and the bond market and the like. Forge, in their entire history, has done 10 billion. Carta did 7.4 billion last year. I mean, we're talking many orders of magnitude smaller for companies than for the equities market. As a result, this is high friction. This is highly manual. This is, and the companies that sit in between, the secondary marketplaces, have to take much bigger spreads. Forge and EquityZen both take about a 5% margin charged to the seller on each transaction. That's necessary to fund this business. There just isn't the volume yet for those spreads to come down. Now, by the way, as volumes increase, expect those to get smaller and smaller and smaller. But for the time being, not much trading. You got to charge a lot per trade.
Well, and as you see consolidation, companies go public. If we consolidate around those 4, and 4 becomes 3 at some point in the future, classic market consolidation. What happens? You compete for market share, price goes down. But it sounds like that 5% and some of those high minimums are kind of where we are. You talked about minimums of upwards of 100K in the newsletter. That's a chunk of money to be then making that 5K sort of premium on.
And two different models here, Stephen. So Forge and EquityZen will engage directly with startups, but they're also engage, assuming that the startup approves it, they will engage directly with employees as if the employees want to sell outside of a startup sponsored program. I'll explain what I mean in a sec. So Forge and EquityZen will work directly with an employee, a founder, an investor, as long as they meet the minimum. And in Forge's case, it's $100,000 of value. In EquityZen, it's $175,000. But EquityZen allows multiple individuals to pool stuff together to meet that minimum. So maybe you get 4 buddies, each of whom only has 50 grand. That's one way of getting it done. Those minimums are in there to ensure that 5% they're making on the trade generates enough revenue to justify the cost of having a person in the white glove service. And again, this is because it takes a while to match up buyer and seller. It takes time. That this is a big investment from the secondary market. Another way to solve that problem, Stephen, is basically to bootstrap liquidity. And what I mean by that is you can set up points in time. You can aggregate buyers and sellers to a single point in time so that even though in general the market's illiquid, at given points, there's liquidity. Stephen, this is, and I'm going to talk about some of the mechanics, but this is no different than saying, hey, rather than having the village market open all the time, all day, we're all going to meet up at 10 a.m. on Sunday. You pick a point and everyone shows up.
So this is companies raised a bunch of capital. They're going to go from Series A to Series B. That Series B event is time bound. We're fundamentally changing the cap table because we're maybe offering more equity to the Series A, or we're bringing in different VCs, or there's an event happening. Whilst that event is happening, we'll give the employees the opportunity to cash out or change their position and become more liquid as part of that Series B. We'll do it again at Series C. We'll do it again at D. So there's that. You time those events around meaningful raises for the company. Is that what you're saying?
That's one really good example, and that one also has the benefit, Stephen, of if a round is oversubscribed, if there are too many investors trying to compete to get into the startup, rather than forcing each investor to take a smaller share, you can take your round from just a handful of investors, and then other investors can also become owners by just buying stuff up in the secondary. So it has an advantage directly for the startup as well.
And that I mentioned based on raises, I'm assuming you could also do this as an annual event, in December. You've got the month to be able to raise. We're not going to do it all through the year, but through the month of December, you've got the opportunity to change your position. Is that kind of the other approach?
Exactly. And that's what Palantir did for a number of years. As I said, it took them 17 years to go public. In their later years, they staged regular liquidity events, predictable liquidity events. Employees could get cash, buyers knew when to show up. Again, you're ring fencing that so that everybody knows the point in time we're all going to meet up at the village market. And again, it's illiquid most of the time, but for those brief moments where you've stuck your flag in the ground, you get reasonable liquidity.
That's your farmer's market happens on a Sunday morning for 3 hours. Right. You've got to wait until Sunday morning for the buyers and the sellers to meet up. Basically, that's the approach here.
Correct. And there are a couple other models. So we can have a tender model. Airbnb famously did this. They allowed secondary sales, but only if you sold back to Airbnb. That allowed Airbnb, they stayed private for quite a long time, to rather than to continue to dilute the cap table with more raises, it allowed them to actually shrink the cap table. Fewer people owned more of the equity over time, so it was advantageous for the startup. As companies get closer to going public, they can have continuous auctions Again, this now dilutes the liquidity, but if you're 6 months out and you've announced you're going to go public, this is kind of a baby version of having a continuous price. That can be very helpful. One, it allows people to get access to liquidity, but two, that price that gets determined in the continuous auction will make a material impact. It will seriously inform the price at which the company goes public. That's a pretty effective way of figuring out what the company is actually worth.
So, as always, we're 30 minutes in, and I feel like we're only halfway through the conversation. Start to summarize us up. I think we're going to get into a series of these. The newsletter you did back in August got a lot of interest. I think this podcast is going to get a lot of interest with the accompanying newsletter. I think we're going to hit this again next week. Other ways to get cash, but maybe just summarize us up if you would, Jared, and then also give that hint to what we're going to cover next week.
So if we look at it from the employee perspective, if you've been at a startup for a long time, you're almost certainly, and the startup's been successful, you're almost certainly equity rich and cash poor. And there are a whole bunch of restrictions in place that the startup will put there to stop you from selling or pledging your equity. And those are put there for good reasons, keeping incentives aligned, staying on the right side of regulations. But there comes a flipping point. And the startup recognizes this probably at the same time the employee does, which is we understand that people want to stay here, but they need cash to get on with their lives. There are good reasons to have access to cash. There's a lot of challenges with facilitating a secondary market. So a handful of major players have stepped up and started to create these markets. On kind of the individualized basis, EquityZen and Forge are really the experts there. On a company-sponsored program basis, Carta and NASDAQ Private Markets are really the experts there. And of course, you can engage either for both, but in terms of where they focus their expertise. Carta has an advantage here for we'll call earlier stage company-sponsored events. If you have your cap table management and you have your 409A valuation and so on already with Carta, all of that's plumbed into their secondary market. It makes trading that stuff much easier. But if you're looking to go public, there's a real advantage to working with someone like NASDAQ, starting to build out that relationship and expectation of when you go public, you're probably going to list on the NASDAQ. Now, that said, all of this comes with the massive caveat of when you sell, you're going to take a massive tax hit. You're going to get all that cash at once. You're going to end up paying taxes out the wazoo. You're going to end up paying them at a much higher rate than you would if you received that cash over time. So there are alternatives to selling. That turns out to be a growing market that's kind of been formed on the back of these secondary markets. It's a little less mature. And it's exactly where we're going to go next week, Stephen, is starting to dive into all the other ways you can get access to cash that isn't directly selling it.
Yeah, and I think that's going to be an interesting transition. We're building an arc of the conversations here from the newsletter that you did back in August through the newsletter this week and the podcast, and then taking us forward. So I'm going to summarize this up. Great discussion. Thank you very much, as always, Jared, for the insight. I think really informative, especially for those people who are working at a startup and who are equity rich and cash poor. You've been listening to the Fat Tailed Thoughts podcast. I'm your co-host, Stephen Dickens, joined as always here by Jared Clee. You've been listening to us discuss the makings of and workings of finance, crypto, and fintech. We'll be back next week with another episode. Thank you very much.